The two new weekly distribution ultra high yield covered call ETFs from Roundhill, XDTE and QDTE, have been getting a lot of buzz lately. But there is a mountain of misinformation out there about them from people who don't have the slightest understanding of how they work. So, if you want to make an informed decision about whether to invest in them, I'm here to help. This is Ethan with Fundamentals of Finance. I'm a CFA Charterholder and investment professional, and today I'm going to explain how these ETFs work, what you can expect from them, and why some of the hidden risks I've uncovered would personally make me very uncomfortable investing in these. Also, along the way, I'll set the record straight on a few of the ridiculous things I've heard other YouTubers say about these that were blatantly wrong, and personally I found deeply concerning. Let's dive in. At the most basic level, XDTE and QDTE are covered call ETFs. If you already know what those are, feel free to skip ahead about 45 seconds to the next chapter. For those who need a refresher, we'll start with that. What is a covered call ETF? In a nutshell, it buys stocks, then writes or sells, that's the same thing, call options on them. A call option gives the buyer the right to buy a stock at a set price. Of course, they'd only want to do that if the stock went higher than that price. So if you're selling these options, like XDTE and QDTE are, that means that someone else gets to benefit from the upside of the stocks if they go up a lot. So to recap, XDTE and QDTE buy stocks, then sell call options on them. That means you get a little of the upside potential, but then anything beyond that set price, which is called the strike price, you give up. And what do you get for giving up your upside potential? A massive yield. And that is the main reason people buy ETFs like XDTE and QDTE. Right now, XDTE is yielding about 35%, and QDTE is yielding about 67%, both of which are highly misleading figures, but more on that later. How do they generate these gigantic yields? Well, they sell out of the money 0 DTE, that's 0 days to expiry, call options against the indexes they track, which are the S&P 500 for XDTE and the NASDAQ for QDTE. Quick sidebar, before QDTE had even been around for 5 months, Roundhill had already decided to change its name. Clearly, they put a lot of thought into the strategy before launching it. They changed it from the N100 to Innovation 100. But, of course, there is actually no such thing as the Innovation 100 index, and it still really just uses the NASDAQ. I literally can't think of anything that would be a stronger signal that these ETFs are nothing more than gimmicks to chase the hot dollar. So what exactly are 0 DTE options? Essentially, they're options that expire on that day. So basically what these ETFs do is sell call options in the morning that expire by the end of the day. Then overnight, there is no covered call, just the index exposure. So you have exposure to the market movements of the S&P 500 or NASDAQ overnight. Here's the diagram they have on their website to help explain it. On the left is what happens in the day, and on the right is what happens at night. In both charts, the dotted line is the return if you just owned the index, which you can see is all that's there at night. On the left, during the day, you have the covered call position on. So your return is actually the solid blue line. This chart is for illustrative purposes only and definitely is not drawn to scale. But directionally, this is how it works. From left to right is the intraday stock price movement, and up and down is the ETF's gains. So imagine the S&P 500 is at 50 when the market opens. What this chart is showing is that the call option they sold is $2 out of the money and pays you $3 of income. Unrealistic, but those are the numbers here. So if the index goes down $3 to 47, the ETF would be even. It lost $3 from its long position in the index, but it gained $3 from selling the call option. Thus, it beat the market by $3. The more the market goes down, the more the ETF goes down. They go down together, but it always beats it by $3. If the market goes up past the strike price, the ETF's returns are capped by selling the call option, which is why the ETF's returns flatten out even as the index continues to rise. They do this mainly so they can provide weekly income payments instead of monthly. Most covered call strategies sell monthly options and thus collect and then distribute monthly income. And no, these ETFs do not compound more quickly just because it makes weekly distributions instead of monthly, like I heard another YouTuber say. Anyone who knows the very basics of how ETFs and mutual funds work would know that when an ETF makes a dividend payment, its NAV, or net asset value, is reduced by the same amount of the payment. So whether you have 10 shares at $11 per share or 11 shares at $10 per share, it really makes no difference. Not going to cause it to compound faster. Whatever the return is in the future, percentage wise, that's going to be your return. And of course, if you're not reinvesting the dividends, then they don't compound at all, ever. The 0DTE weekly income strategy has many potential downsides. The one that all the novice YouTubers point to is that its income is incredibly inconsistent. This is right. But what I haven't heard anyone explain is why that's the case. People talk about it like it's a downside just for these particular ETFs. But it's actually a structural issue that impacts pretty much all covered call strategies I've ever seen, except for SPYI and QQQI, which are managed specifically to make the distributions more consistent. But the more frequently you pay, the more inconsistent it will be. That's just the general nature of the stock market and options markets. The pricing of these options they're selling, and thus the income they generate, is based on market volatility. Some days are more volatile than others, and those days will generate more income. That's one of the reasons I think investors should not rely on these for income, but in my opinion, it's not even the main one. That leads us to why I said earlier that the yield figures were wildly misleading. You can see here that what they're showing is just the most recent single distribution, annualized. It's what an investor would receive if the most recent distribution remained the same every week for 52 weeks. But do they remain the same? No, not even close, as we just saw. So that yield figure will tell you absolutely nothing about the actual yield you can expect going forward. And it will tell you even less about the actual investment return you can expect going forward. Highly misleading. Then, there's also the fact that a lot of the returns on these are return of capital. Often the fund pays out more than it's actually making. When that happens, some or all of your income is coded as return of capital. Essentially, they're just giving you your money back. If you don't reinvest it, your investment will just dwindle down over time. This is a problem with all covered call ETFs, but it's particularly bad with these ones because the 0DTE options and weekly distributions amplify that effect. That's the main reason these should not be counted on for income. Another way they will be less consistent and less predictable, even than other covered call ETFs, is through their price movements. Since they leave you exposed to all the price movements overnight, but then cap the gains of the market movements in the day, it makes the ETFs especially vulnerable to big overreactions to news when the market is closed, which is when most big news happens. Elections, earnings announcements, mergers, pretty much all are announced when the market is closed. I distinctly remember the day when Trump was elected president in 2016. The market was way down overnight in major panic mode. Then, when the market was open, it recovered and actually ended up well into positive territory by the end of the day. If this ETF had existed back then, it would have locked in all that downside overnight and then gave away the recovery in the day. Of course, it's also possible for the opposite to happen, where the market could overreact to something in a positive way overnight and then cool off during the day, which would benefit the ETF, but in general, this just opens it up to additional risk and unpredictability. Then, there are issues with the 0DTE flex options that the funds use. These are customized, they offer lower liquidity and higher bid-ask spreads than regular options. That translates to higher costs for the fund and a risk that in a really volatile environment, they may actually have trouble taking these positions and generating the income investors are looking for. An even bigger concern is that 0DTE flex options are a nascent market, meaning very new. From what I can tell, these ETFs aren't using them irresponsibly, but many investors are, and I think there's a non-zero chance that the markets could seize up or experience a significant adverse event along the lines of a flash crash or something like that during a period of major market volatility. We just don't know yet. Another factor adding to the high risk profile is that XDTE and QDTE are both highly concentrated in US tech stocks, especially QDTE. Put it all together, and it's probably no surprise to you that I find these highly unattractive, and I would not invest 1 cent of my own money in either of them. If you choose to do so, I hope this video has helped you get a better understanding of the role they might play in your portfolio, and I wish you the best of luck. I may not have told you what you wanted to hear in this video, but my goal is to tell you what you need to hear, good or bad. If you enjoyed hearing an honest, informed, well-researched, professional opinion, hit that like button and subscribe so you can be notified when we put out more professional level research for free. And if you want to continue the investment conversation with my partner Kyle and I, you can click the link in the description to join our Discord, which is also free as I'm recording this, but may not stay that way forever. Thank you for watching, and we'll see you in the next video.